Consumers are impatient. They want everything from groceries to personal care products to home appliances in their hands as soon as possible, and they want to shop without leaving the comfort of their homes. It's this love for instant deliveries and couch shopping that has fueled the meteoric growth of the quick commerce industry in India. In FY24, Blinkit clocked 20.3 crore orders. Armed with 526 dark stores, it saw gross order values growing 93% to 12,446 crore rupees. Swiggy Instamart, with its 600 dark stores, clocked 17.6 crore orders, with GOV growing 58% to 8,100 crore rupees. Zepto, meanwhile, is quickly playing catch-up. Sales crossed 5,000 crore rupees in FY24, and the company plans to scale its dark store count to 700 by 2025. Elara Securities estimates the industry is currently worth between $3.5 to $4 billion and is slated to grow at 25 to 30% over the next 5 years, at least 5 times faster than e-commerce.
Yeah, I think it has taken a lot of people by surprise, including me. I think the promise has been kept by the players. When the GMV rates are very, very good, the brands are supporting the quick commerce players simply because they now see customers. Investors obviously have believed in the potential of quick commerce in India. And once they've seen very good traction and very good execution by the founders and the team, they have not stopped shy of pouring more money.
No surprise then that incumbent e-grocers like Big Basket, who once viewed the unit economics of quick commerce unviable, have changed their mind. Even e-commerce players like Flipkart, Amazon and India's largest retailer, Reliance, now want a piece of this pie. Experts say that the growth prospects endorse this interest, but add that growing average order values and scalability of operations will be key.
If you have an average order value of 500 to 550, and if you do roughly around 2,000 orders per day, a quick commerce dark store would largely be at a break-even point. So that is the math there. And I think definitely the business is quite sustainable, because I think if you look at some of the mature stores, I think they are already making healthy EBITDA margins. And if 2,000 orders, if they are doing a break even on that point of time, if these orders are maybe 4,000, 5,000, then definitely you'll get healthy EBITDA margins as well.
For consumers, the big draw is not just ordering from the comfort of their homes, but that Q-commerce platforms have been consistently adding to the range of products available under one app. Experts agree that it is this strategy, along with entry into new markets, that will ultimately drive business growth.
We launched Nasik last month. Right, Nasik is not known to be like anywhere close to a metro in terms of a market. Yeah. The stores that we launched there have hit 1,000 orders per day in 6 weeks. It's the fastest that we've ever been able to achieve that. When we go into these tier 2, tier 3 markets, customers come and tell us that, hey, I actually couldn't find this selection anywhere else, right? Or I couldn't find this quality control anywhere else. And so we think we have an even stronger value prop in those markets.
One of the things that the quick commerce business needs, because of the slightly lower average order values, is basically high density, right? And that's what we need to do. And so as you go to smaller towns, it gets thinner, and that can impact profitability. So we'll be careful in terms of choosing towns.
But as more players enter the fray, a shakeout is inevitable. Consumers may be spoiled for choice, value and service as new players enter the market. But experts say 5 years from now, the market may not be enough for all of them. And this will lead to the less nimble and those struggling to achieve scale quickly breaking under pressure. The spate of consolidation that will follow, they say, could leave the quick commerce market with just 3 to 5 players.